can I ask you to introduce yourselves, please? Should we start with Helen, if you'd like to take us through?
Hi, hello, my name's Helen Hatton. I think I know most of you. I'm here in the capacity of being chairman of KYC Worldwide.
Hi, my name is Mehul Kotedia, and I'm the founding director of KYCME.
Good evening, my name's John Day. I'm here representing a Jersey-based development called KYLI, which is very similar to what you saw with Vix Verify.
My name is Tom Devlin. I represent KYC 360 Technologies Group, which is a local group of fintech companies working in the financial crime reduction space.
Hello, I'm Dan LeBlanc. I'm here as a director of Elian and the creator of the ID Check app.
And hi again, I'm Hamish Armstrong from the Supervisor.
Matthew Beale, Comsure. We have a product called iTrack Risk that enables firms to risk assess and facilitate the tools that my colleagues got.
Okay, excellent. So we've got half a dozen questions prepared. As it's quite a large panel, could I ask you to be very succinct in your sort of opinions or answers so we can get through this quite quickly and then pass it on to the audience for questions. So our first question, as we look forward to this new digital world, what do you think are the biggest challenges, given that KYC is probably as mature as it can be given the sort of manual process or the paper-based process? When you bring in technology, what do you think the challenges are that really that face the KYC industry?
It's like pass the parcel. I think I've been holding the. I'm going to point to my friend, the regulator, I'm afraid. I think the paper-based world, we all know, has wasted a lot of time over a number of years. Technology, fintech or regtech, as I like to call it, is definitely the solution that's enabling us to do our jobs more efficiently. Unfortunately, and this is not a criticism of the Commission, the Commission do a job, but I think regulators are designed like they are, they're not entrepreneurial. They're following other lawmakers, so they're looking outside to ensure and trying to meet what they call international standards, and there's a lot of interpretation in regards to that. So unfortunately, I think there's got to be a sort of a combination of the entrepreneur of the industry talking to the regulator to ensure that everybody can move together to ensure that what we're doing meets the high-level standards. Because there are high-level standards. Moneyval, IMF, FATF don't prescribe exactly. They just say you need to know your client. And if we can satisfy that, we'll be ahead of the game.
Yeah, I tend to agree. From the supervisor's point of view, I think the biggest, greatest challenge is to get somebody to start doing it. And I really think there's not just in fintech, but this is a KYC, and AML in general. There's a lot more. As has been mentioned, there's a lot more scope for flexibility in the regime than compliance officers in general seem to think. Compliance officers think about risk all the time. That's their job, is risk. And they think, well, I've got the system already. When I get all these passports in and all this paper-based verification, why would I change it? What's the benefit to me? I think the biggest challenge is getting someone to just take that leap into what is the unknown. And it's up to us as a regulator, and I fully accept that, to make it clearer that that's totally possible. We're not trying to prevent that. But I do think that, someone has to take that leap, and you might find it's a lot of other regulated persons follow on very quickly.
Okay, so that's interesting because Elian have been doing electronic CDD for more than 2 years. Elian are one of the largest trust company businesses in Jersey and offshore, so we're already there. But I think the biggest challenge we face in terms of dealing with KYC is not in respect of individuals. Certainly at Elian, it's not a problem. We got that whipped. We got an app, been using it for 2 years. The big problem or the challenge we face is doing KYC on legal bodies, companies, trusts, and alike, and the amount of time and effort that's required to get over the line there is multiples of doing an individual, because you end up with 3 directors and 5 shareholders and 4 protectors and 10 beneficiaries, etc. So anything that helps make available more tools to get over the line there and deal with companies that are are in a global client base for us, it could be anywhere, will help us meet that challenge. If you're a UK retail bank, it's a pretty simple, straightforward challenge you have. If you're an offshore trust company, that's a whole different ballgame.
So far this evening, we've been talking about knowing your customer in terms of identifying them. And as some others have said, that battle has effectively been won. So far as I can see, the technology is there to easily identify your customer as in who they are. It may not yet be in wide usage in Jersey, but it is in other markets, as we heard, particularly in Australia and elsewhere. And to my mind, the challenge is not so much that, it's how we apply technology to the next question, which is truly knowing your customer. If you think of this in historical terms, we have moved from a mass market era of compliance over the past 10 years, in which banks and trust companies and other businesses have had to massively increase their compliance resource in order to deal with the bureaucracy of collecting passport copies and utility bills. And that era, it seems, is drawing to a close, as well it might, in a low interest rate environment where all of a sudden returns on capital are not what they once were, and big banks cannot afford to have tens of thousands of people employed in compliance. So to my mind, the challenge is to move beyond using the machines to do what is frankly the easy stuff, reading an ID, confirming that it matches a database, and on to the much harder topic, which is assessing the information that we hold. What do we know about this customer? What risk do they present to us? And trying to use machines to perform some of that work, which until now it's only been possible for quite highly trained compliance people to undertake. So to my mind, that's what the next 5 years will be all about.
Thank you. Very simply, I think this is now a technology issue. It seems to be lacking a roadmap, a very clear roadmap, and some standards. You've got 6 different KYC apps here just from Jersey. Extrapolate that across the world, that's a lot of different approaches. It's the consumer or the customer doing this. That's not much better than all the disparate paper processes. There needs to be some standardized and interoperability for this to be user-friendly for the consumer who has to do it.
I think there's been enough answers that I don't think I can repeat myself. I think the key here is that as a business, there is a difficulty in deciding which is the right tool for you without being taken apart by the regulators, for want of a better word, and understanding who provides what service to what level. So the challenge is as fintech improves for KYC is which is the right technology for what business. And there are loads of service providers, all of us here sitting doing our bit, but it's trying to convince them. A classic example is when we first started, the first question was, well, what do the regulators think? They're happy with it? Okay, go away, come back again. Which banks are going to accept it? Oh, okay. So we're working with them as well. At the next layer, you go with the banks, and they say, okay, great idea. We now have an international policy to deal with as well. So there are these hurdles that are going to come up, but I think the point for people like us over here is to keep persevering, but getting the right message across to everyone that as long as you do the right steps in the right format, then any one of these solutions, provided they meet the risk factor, should be acceptable.
Yeah, good luck. Thank you. It's a bit tricky when you're at the end of the line. My note, because we very kindly had some advance notice on these questions, was that the key challenge was fear of dynamic change in an environment steeped with regulatory peril. So I think that captures much of what colleagues have said. I think then the second issue, and I was very taken with the presentation earlier, I thought it was a very interesting service, is that the majority of the mainstream providers are geared for retail customer applications in large onshore jurisdictions. Well, unfortunately, the majority of our business is very different, and our business is all about cross-border stuff. It's all about complex structures. It's all about linking quite a considerable number of individuals and structures together to understand the rationale. Our primary driver is not, we have to have the photo ID and what have you, but our primary driver is source of wealth, source of funds, and the rationale for the structure. And that's the hard bit to understand. So I think you know, when you're looking around at the various different product providers, the collection of data is really only a tiny bit of the overall issue. Certainly needs to be collected, it certainly needs to be verified, and getting that done in a cost-effective and quick way is great. But it's the source of wealth, source of funds, the rationale for the structure is the critical bit for regulatory compliance in our environments.
Okay, thank you. Would anybody else would like to comment on the challenges for fintech?
Hi, yes. Good evening. Thanks very much for a very interesting presentation and answers so far. If I was to put this to you, how would you feel? It would seem to me that in order to get the traction that the Commission and the regulator would like to see, there needs to be some basic investment decisions by the people likely to use the system. And yet I could predict, or I suspect that there might be a case of almost a VHS or Betamax decision here. You could quite easily invest funds in something which is completely the wrong horse to back, especially as one of the panels just said quite clearly, there's 6 or 7 apps already on this island, so there's a lot of potential Betamaxes in the marketplace. Be interested to know whether you think that is just a basic decision and how one could overcome that.
Well, I don't know if it's best being first or last, frankly, but I'll give it a go at the other end of the tail. Obviously, as a provider ourselves, when designing KYC worldwide, I came up with a matrix to assess what other service providers did. And that's not hard. You go onto the FATF website, you download the assessor's methodology, and you pull out all of the bits that a financial institution has to be able to evidence is in place. And then if you were evaluating to do your decision, you need to tick off which bits one particular service provider does versus another, and then you'll see where the gaps are, and you'll be able to assess like for like. It's quite straightforward. I mean, you know, I'll give you the template. It's not a big deal. It's just straight off the FATF website. It's not hard. And then you can see which bits you're going to continue to do manually versus which bits you're going to buy some technologically driven support from. And you could then evaluate what money you could save from that particular adoption, and indeed how they bolt together. Because some are competitors, the majority bolt together.
So all the same thing before I'll move on to the next question. We'll be here all night.
I just maybe just throw one. I think just to take your analogy between Betamax and video, I think actually you might throw the Apple iPhone in there as well, because I think where we are with technology now, and it's kind of quite interesting, I think we're at sort of a tipping point. Maybe in 5 or 10 years' time, I think some of us will still, if we're still in the industry, will be looking back going, I can't believe the passports and utility bills catch criminals. You know, the reality is there's a lot of clever people out there in the fintech industry that are way ahead of us. And again, you can go on Google and look for it. But I tell you what, if they walked in to my regulators and said, this is how you catch them, there's no way that they would be approving it today. So there's got to be a decision, there's a tipping point in where you spend your money. At the moment, and I don't see any change in the near future, it is about passports and utility bills as stage 1, and that's either your direct client or those settlers, protectors, whatever. That's the minimum what you're going to have. It's all the other stuff.
Let's move on to question number 2. So, interesting, you just mentioned Apple. So how do you think these authentication technologies, such as Apple's Touch ID, will feature, or biometrics are going to feature in KYC?
I think it was covered in the presentation, but I think it's a fairly fundamental part of the future as we evolve to the more technology-driven stuff. The Touch ID, the biometrics are a given. I think it will be important to pick the path that uses them as authentication, sort of two-factor authentications, rather than passing of that personal data. There's a privacy issue here, and there is a shortcut that just says share all the private data. there are solutions and technologies now that we can use those biometrics to prove the person was there and they were live and the thing wasn't stolen without having to actually pass that over. So tokenization that they're using in Apple Pay, for example. More importantly than the biometrics that are out there, I think the interesting one for corporates will be Microsoft Hello and Microsoft Passport. They are open standards. They came out with Windows 10. That's using iris, fingerprint, and depth camera for logging in. You'll see the challenger banks using live video with those sort of tools for just see you log in, and it's automatically happened behind the scenes.
I think that's led on to an interesting thing that caught my eye. I think the presentation we saw earlier on is designed at two levels to apply at two levels. The one issue is the AML compliance that we have to do as financial service businesses to comply with the regulatory requirements. The other is once the client's in, actually having a system to allow the client to transact. And, as an organisation, once you've admitted that client, being able to get them in to authorise transfers or what have you on biometric information, I can see how tremendously convenient and great that would be, voice recognition, fingerprints, iris, whatever. But I'm not so sure that represents independent verification as is required in the Jersey legislation for AML-CDD. If I spit in the palm of your hand, that is my spit. It is not independent of me. I don't think biometric alone meets the verification standard required in our current legislation. A lot of other jurisdictions talk about reasonable measures. Ours talks about independent verification. So biometric alone, I don't think does it for AML compliance, but it would do it for a fabulous way of getting your client to transact once you've admitted him.
Can I fall off my chair? I think in a few years' time, all this will be academic. We'll be all using an Apple product or a Google product. It will be industry standard, and if we, the finance industry of Jersey and the regulator don't get on board, we'll lose business. So we'll get on board. So this is all just interim stuff. I wear two hats as somebody who looks after a trust company business's CDD functionality and somebody who developed our own app to help do that. I'll be as happy as any of you out there if my app becomes completely redundant and something a lot easier comes along. So in 2, 3, 5 years at the stretch, we won't be having this conversation. We'll all just be getting our phones out.
I think notwithstanding any earlier cynicism that I might have evidenced about the importance of identifying one's customer, there is a clear role, as others have said, once someone is inside your organisation and checking that they remain the same person as they seek to access your services. One of the key vulnerabilities that we see, and we have observed major banks trying to combat with varying degrees of success, is that they have someone who applies for an account and passes all of the DD checks, gets their account, and then just sells it to somebody else. And that other person, as things stand, on most banks' platforms, will have no difficulty whatsoever in logging into online banking, carrying out transactions, and doing pretty much whatever they want. So far as the bank is concerned, the customer remains person A, who opened the account, but in fact it's being used by person B. Now what we're seeing at the moment is banks who are looking to do fairly straightforward but nonetheless effective measures, such as, for example, where is this person logging into their online banking? Where in the world is it happening? How does that marry up against what we think we know about this customer and where they're supposed to live or do business? Where are their transactions going? But this biometric data, I think, if done properly and made easy enough to use, does provide a powerful safeguard against that kind of exploitation, which is otherwise very difficult for financial institutions to detect, particularly when they're dealing with volume business as opposed to a relatively small number of trust or company structures.
Okay, we'll take one comment from anyone in the audience if they have one.
You brought on a very interesting point, which is the continuous use. I tend to have a bias around the Apple Touch ID at this point, because if my husband I register his print, he can then go in to access my accounts. So for me, I think that there needs to be, I'm not sure PKI is the answer, will be the answer, but something in that level which uses something that you know and something that you own, rather than what the answers seem to be, at least on this side of the world, different than what's going on in the continent, is that they're using the mechanism of PKI as a second authentication, which then removes that ability for people to actually trick the system.
Well, there'll be a lot of thumbless people around.
So here's a more interesting one that's focused on the regulators. So what are specific challenges do you think this presents for regulation? Not just in Jersey, but of course everywhere.
If I may start, I think that the key challenge for regulators, and I would love to say present company accepted, perhaps it is in recognising that as they increasingly demand real-time risk appreciation on the part of their licensees in respect of their licensees' customers, it becomes less and less defensible for regulators themselves to be working effectively on what's almost a paper-based system back at base when assessing their own licensees' characteristics. There is an enormous potential contained within the current scope of technology in this space, not only to make it easier and clearer for licensees to assess the risk profiles of their customers, but also to feed back information in real time or near real time to their regulators, so that we have a much more integrated and up-to-date viewpoint on the regulatory side as to the risk which particular licensees may pose even from day to day. In licensed entities, it's fast becoming unacceptable to only spot a risk once every 1, 3 or 5 years when you do your annual or triennial review. Regulators, rightly, driven by FATF requirements, now expect a greater degree of effectiveness. And it's only fair, I think, that they are held to the same standard, and they are being held to that standard, that they themselves have a greater appreciation of the changing risk profiles of their own licensees than what they might get from a quarterly or a semi-annual return. So I think the challenge for regulators is to embrace this technology and use it to up their own game, as well as naturally imposing their reasonable expectations on their licensees that you can no longer get away with doing things once a month, once a quarter, once a year.
Okay, but that would imply that the regulator also has to upgrade their tech to handle this incoming data. So there's a whole side there about regulator technology, right?
Yeah, so understanding technology is going to be the biggest challenge, and identifying the risk that comes with the technology. I think you alluded to that at the beginning. But the fact that you are talking to the service providers does give you a bit of helping hand, but I think it's going to be going outside Jersey, outside the Channel Islands, and seeing what everybody else is doing. I mean, there's a big initiative within EU called the 2020 project, whereby they're going to have EU passporting. So you can use the ID for the one ID and can transact anywhere around EU. So those sort of new technologies and ideas are coming through as well.
To you, well done. The challenge for regulators at this point in time, particularly GFSC and JFSC, is to ask themselves, why do we have the current situation that Hamish explained earlier? Why is it that financial services businesses in the islands have been so reticent to step forward? What is it? Because out of the 100 or so pitches that I've done, most of them in Jersey, Guernsey, it's about, the message I get is, what a great thing, that's great. I'm terrified to do this, I'm going to wait. So what role has the regulator got to play in that dynamic?
Yeah, indeed, and I absolutely agree. And as I mentioned earlier, that's part of me being here tonight, and that's what we're going to be working on over the next 12 months with our outreach in this space and trying to get that message across that we're not preventing this happening. It's not necessarily a bad thing. In fact, we see it as a good thing if it's done properly. I mean, for me as a regulator, the biggest issue for us at the moment, to be honest, is a lack of technical understanding. We've said already that just on this panel is a half a dozen different products that might be used. in 12 months' time, if we have a population of regulated entities on the island that are all using 100 different products, it's up to us as a supervisor to go in there and understand what those products do, understand what the risks are, understand what all our relevant persons are doing. That's a big challenge for us, and we need to up our game. We need to get some expertise in. We need to learn more about this, and that's why we're quite keen to get involved in these kind of forums where personally I'm learning stuff tonight as well as hopefully getting a message across.
May I? Sorry, don't want to make this too much. But this is the first time I've heard the Commission in the more than 2 years I've been focused on this stand up in public with such a positive message, and I welcome that and thank you for that. But in March last year, when we had a Jersey Finance presentation and Andrew LeBrun was on the panel, that wasn't the message we got. When the questions came out from the floor, looking for some kind of reassurance, that wasn't the message we got. So if it takes the JFSC and the GFSC and other offshore regulators 2 years to make that transition, then the trust company businesses and fund services businesses that are going to flourish on this island are the ones that have got the balls to step up and go forward at the front of the pack, and the others will fall by the wayside. And that's not particularly good for Jersey.
Well, a number of us were there in March, and I was certainly there and on that panel. And I don't personally recall Andrew's message being negative in that way. I think,
it wasn't this message. It was absolutely flat.
No, I think.
Figure it out yourself, guys.
I
that
think
was the message.
the message that Andrew gave was that the Commission had reservations about the new technology solutions that, for example, were going on the biometric line, whereas technologically supported traditional methodology they were completely happy with, and the middle ground was something they were exploring. And that exploration has taken a little while. We've had a consultation document and a public statement. So I think
it'll only take 2 years on the cycle, so don't worry, we'll be fine.
Well, I think what issues do these new technologies present for the regulators, both in Jersey and in corresponding countries? The financial services industry, the individual companies, are wholly entitled to take what risk-based approach they choose to. It's your balance sheet, your profit, our balance sheet, our profit. But the regulator has to square up to the international standard-setting bodies and maintain the rating for the island. Do you want them to take risks with the island's rating? They're always going to be more prudent than a commercial organisation. That doesn't mean that they're not willing to move forward, but it will mean that they're not going to be leading the charge on that. I mean, I don't think any of us can expect the regulator to do that, in fairness, fairness.
Should we take a comment from the audience?
Do you think there's scope for you all and the regulator to work together to help explain to your community, your trust companies, your banks, what's on offer and what are the pros and cons of these different products? Because it may very well be that they're very confused in a very populated space. And it struck me when VIX Verify, during their presentation, it's a wonderful tool for verification, but I was struck by the aspect that deals with sanctions and PEPs, which is a particular sort of pet interest of mine, because someone can be on a sanctions list, not be on it one day, and the next day they can be. And is there risk of compliance here? Because if a company have their VIX verification check, they've had their sanctions check, that person was all clear, what happens the next day? And is the consumer aware of the need, that there's going to need to be an ongoing process there?
On to the next question.
Yeah, I was going to say that's a fair comment, and some of the products that we hear about do tend to focus on the upfront ID and verification, and that's absolutely brilliant. But it's not the end of the story. CDD, customer due diligence measures, are way wider than that, and we've already heard about source of funds and understanding the control structure are all additional information, additional things to think about for our firms that some of these products may not cover. These products are great, but they may only be part of the total CDD solution. That's our view.
Okay, thank you. So let's move on to the next one. So specifically risk management, what's the impact on risk management of KYC, of the new KYC technologies?
I think that one of the opportunities that the new technologies present, beyond the identification of your customer, which is important, is in gathering all of the factors that you need to consider as a business and analysing them in a systematic way. Now, if you're a TCB with 200 customers, that may be of limited interest, quite frankly, because you can do that yourself. But if you're a bank, or if you're a big fund administrator, or if you're a larger TCB and you're dealing with thousands, hundreds of thousands, perhaps millions of customers, what technology gives you the opportunity to do for the first time is to have a personal window into every single one of those customers, if that's what you want. There are systems available right now which will enable you to risk profile not just an individual customer, but your entire business line or customer base. And this has an enormous impact on risk management. One of the key areas where we see it having an impact in Jersey, one of the first jurisdictions to require organisations to have a business risk assessment, is that for the first time it will enable firms to have a truly dynamic business risk assessment document and to evidence that to their regulator. So if the board decides for one reason or another that its risk tolerances have changed, it can now demonstrate that there is a good, solid reason behind that change based on the risk characteristics of its customers. Another potential application is this. If the regulator or if the group that owns your business and is located elsewhere proposes a change to standards and there's a consultation, you can now, using the new technology, model what the impact of that change would be on your customer base and the profitability of your business. And so if you need to respond to the regulator or to group bosses in London or New York or wherever they are, you can do so on an informed basis. So in summary, I guess the big impact is the new technology provides you with a window into what was previously sort of a haystack. You can now see where the needles lie. And that is a tremendous advance.
No, I completely endorse those remarks. I think they're absolutely right. And certainly our system, I know there are a few others as well that do the same thing, will produce all sorts of infographics to support the MLRO or MLCO's report to the board. It gives you real data. When the regulatory requirement changes, you can immediately see the impact, the cost. I think the old horror of deficit KYC creeping in as a few things change and there are a few trigger events that aren't picked up and so on. That's where the impact of the technology really hits because it's so quick. All these backlogs in file reviews and what have you, they just don't need to happen anymore. And so I think how risk management might be affected, to me the biggest thing is that it gets the, if you like, the heavy lifting, the dross stuff off the desks of your pretty expensive compliance officers and allows them to start adding much more value to managing the risks in your business. So I think it's an economic issue. It just gives you more bang for your buck, really.
Just sort of kind of harping back to an earlier question. It is all about big data. I think one of the challenges for us, maybe in the Western Hemisphere, the old legacy banks, legacy systems don't give us the information. And this is where fintech and a lot of you guys are coming in because some of the tools and applications where we can drag this data out, we can start analysing it. And as Helen says, suddenly your £100,000 compliance officer is not going to spend 3 weeks preparing a board pack where they can press a button and do it in seconds. It's about getting all that data. So again, I think we're on a tipping point. The technology and the thinkers, then the technology is there. We've just got to be applying it.
So virtual currencies include anonymity and outside the mainstream. How do we bring these in? So this is quite a hot topic, isn't it? Virtual currencies, Bitcoin, blockchain, this whole thing. How do we bring them into? How do we bring them into regulation? Can they be brought in? What are your thoughts around virtual currencies?
We have an expert over here. It's down to government, and different governments are approaching it different ways. I did a bit of research on this, and we haven't got enough time to go into it. So I think how this is going to be dealt with in the short term is definitely through the AML rules. It's not really about the virtual currency, Bitcoin, whatever you call it. It's about how the people dealing with it are dealing with the risks that are associated with it, and there are risks associated to it. So it all comes back to the things that we've been talking about. How do we know who's using it, is doing it legitimately, and did they do what they do legitimately, I think.
How we can bring it into regulation is an interesting one, and it seems that the international sort of movement of travel seems to be to regulate, if you like, the on-off points, the nodes where the virtual currency is exchanged to fiat currency, to real currency, and you know, I'm sure you're all aware, Jersey had a consultation last year about the direction that we should take here in Jersey in terms of regulating, and I believe some legislation is being drafted as we speak, and we'll be one of the first jurisdictions to have some movement in this area. Not the first, but one of the first. And so that exchange between virtual currency and fiat currency will be regulated in the same way as exchange between two currencies is regulated. That's how these risks can be brought into the regulated community and managed.
Good luck with that would be my response. It's right that, of course, that Jersey has proposed that it will attempt to regulate virtual currencies, and I applaud that, but they're like a kind of hydra, as are many things in the modern sort of informational technology world. As soon as you regulate one, another informal, unregulated form of value exchange will spring up. And there is now, when you combine this with the phenomenon of de-risking, arguably a gun to the collective regulatory head, which is this. If you make it too difficult for people to access well-run, well-regulated financial services based in centres where people are actually looking at suspicious activity reports and attempting to track what is moving through the financial system, what you will give rise to is not just challenger banks, but completely alternative means of value exchange which are completely outside of the regulatory purview. We've had a lot of talk about tipping points this evening. I don't want to add another tipping point to the mix. But I genuinely feel that if collectively the world does not get its act together in a sense, reining in some of the due diligence requirements that it's imposed, some of the risk tolerances that it's imposed, the bigger danger is not that a few people abuse the services of legitimate financial institutions for ill. It's that those people disappear off the grid altogether. They find new ways of doing things which we can't see, and they stick to them. So I think this is a real challenge for regulators and for industry to grasp that nettle before that movement acquires an unstoppable momentum.
I think the Jersey regulator was spot on with this one. It did take two years of negotiation, but we were the conversation was ahead of itself. And that consultation did come out with the proposal, as Hamish said, to regulate the on-ramps and off-ramps where physical currency meets virtual currency. It seemed to be practical and common sense. If we treat it as a currency and do all the KYC due diligence as we would if we were a money service business, we're applying common sense and practical risk mitigation. The EU in the last couple of weeks has said it's going to suggest doing exactly the same. So fortunately, even though we've gone ahead, our legislation is looking spot on in line with UK and EU suggestions. It is fairly light touch, but it is strong risk mitigation by doing the KYC at the on point and the off point. And it's actually not anonymous, it is pseudonymous. So actually, by doing that regulation at the on point or the off point, you've got an audit trail from that point onwards forever, which cash doesn't have. So it's actually better regulated from that point than cash as we stand today.
I don't think I can add any more.
Don't you love Bitcoin? I mean, it's just fab, isn't it? Imagine an environment where you separate the state and fiscal policy from money supply. It's like the Reformation times 10. It's extraordinary.
Does anyone make a comment from the audience on this?
Just a question around, do you see the underlying technology of say, Bitcoin? There's a lot of research around blockchain technology. Do you see that as a potential benefit for maybe regulators or audit trails, as John said, to be able to say that it is an indelible, audit trail going back or going forward as far as the user has been on the system is going to be a benefit for, say, regulators going forwards?
shared my vision earlier about pulling out your phone and everything's on your phone. It may very well be that blockchain is part of the technology behind that helps actually set in stone your identity, and then you share that along with others, with regulators and service providers. So yes.
Yeah, without knowing too much of the technical detail personally, I do know there's a lot of thinking going on in this space, both in the private sector and in regulators, especially registry, for instance, is definitely thinking about this as an option. As an option, and I know, personally, I think it's probably inevitable. It seems to be chugging its way towards us like a train, and it's not going to go away. And I think it's something we're going to have to deal with at some point.
Yeah, it's a great question, great observation, because. And I am going to throw tipping point in again, because the presentation today, which was very good, and it's for here and now, but the reality is from what I've been reading, blockchain seems to be where this will be in 10 years' time. The idea we own our identity, we own our documents. We talked about Apple. I just got a news item on my phone, which I read. The guy's in Ireland, where all our data's held. It's not uncommon for them to be approached 30, 40 times individually and being offered 20,000 euros each to give that data over. They're being bribed daily. That's kind of the world we live in. So to actually own our own data through blockchain and be able to present that as and when, rather than being, I'm going to open a bank account, get my phone out, take a photo. God, in 10 or 15 years' time, we're going to think we're mad.
Okay.
The answer to the next question, actually.
The answer to the next question is we're mad. Okay. So just to wrap this up, and just a very quick summary for each one of you, what's your blue sky vision really? What's the end game for KYC? And I know you've given us a bit of that already, but we're all mad or whatever. We'll think whether we're mad. But what's your blue sky vision? We can just work around the panel, please.
I think that's it. I call myself a technophobe, but in my reading, seeing where reality is here and now, we haven't changed for 20 years. Okay, the technology around it has changed, but the reality is we're still where we are. Criminality exists, fraud is exponentially rising, money laundering is exponentially rising. Regulators aren't stopping it. Regulators are just doing a job because that's what they're asked to do. Reality is there's some clever people out there, and I think blockchain seems to be it. There's been people working around it, and we can suddenly own our data. Nobody's going to steal it because we own it, and therefore we can use it, and actually it adds value to everybody else. But that requires clever people to start getting their head around it and talking to these guys.
In terms of blue sky thinking, the end game for KYC, from a supervisor's point of view, we want to be in a place where all our regulated firms know their customers. We're agnostic about how they do that, and if technology lets them do it better, then we're all for it. And as I say, if you don't remember anything I've said tonight, just remember that we're not preventing this happening. If it's done properly, we're all for it.
So imagine if Facebook tomorrow announced that as part of their account, you could verify yourself once with Facebook, and then they'll share that with your service providers and regulators, etc. Maybe Weibo did that in Asia. Maybe, just takes one or two of those monsters to do something like that, and then governments, regulators all over the world follow on, and we're not having this conversation anymore.
It's Blade Runner crossed with the Matrix. Dystopian thinkers imagined once that we would have chips inside our brains which would tell the government what we were thinking. And that's not necessary because we do it voluntarily. We publish so much information about ourselves without even thinking about it on social media and other forms of communication, that to my mind, the ultimate end game of KYC is predictive information about customers, measuring sentiment in a way that's already possible through Twitter, Facebook posts or whatever, attempting to identify who the bad guys are before they abuse your services rather than after it's happened. So a little bit creepy perhaps, but I think ultimately it won't be too long before we're there.
I may be very biased as a member of a blockchain consulting company, but Dan's view is very, very realistic. One of the Facebooks, Googles, Apples are going to be the one-click solution to your ID, but for that to happen, you will have had to give away all of your privacy and everything to them because they're taking it for free. I would like, in an ideal world, to see Jersey using blockchain and other services to create a solution that doesn't give up your privacy, and does work as a global solution that is a tool that could be used instead of seeing the Facebook doing it first.
So we already do that, where you control your own ID and share it as and when you wish it. However, going forwards, I think you, Eddie, you and I were talking about this biometric, where it will all be biometrics to the extent that how we stand, look, how we move. So as soon as you walk somewhere, they know that's Eddie, this is Mehul, and you get on with it. So that's, or even worse, as my son was saying, maybe in a few years' time, kids will be popping out with their own IDs as soon as they pop out. End game, done.
Gosh. Well, lots and lots of thoughts, lots of ideas. I've made some rather lengthy notes, which I think I'm going to abandon on this and end with perhaps two thoughts. The silly one is, of course, my blue sky thinking is world domination for KYC worldwide. And you'll have to see me later to see if you share that vision. But more seriously, I think the end game is probably that whereas in the 1960s, people who founded Jersey as a financial services centre saw the vision as being Jersey as a safe haven for money. I wonder whether a future might be somewhere, maybe here, maybe elsewhere, as a safe haven for personal information. I think there's a whole new industry coming out about this because our ID is the new asset.
Okay, well, I think on that we'll close the panel. Thank you very much, all of you. Thank you very much indeed. We'll sit down again and I'll just close up. Thanks very much.